Since January 2022, car insurance in America has gone up 55%. The companies collecting that money just posted the most profitable years in the history of the industry. Here is how it happened. Number 1. How car insurance is supposed to work. Car insurance is not a complicated idea. Everyone who drives pays into a shared pool. When someone has an accident, the pool pays out. The insurance company manages the pool, takes a margin for doing so, and in theory, everyone is protected from a cost they could not absorb alone. For most of the 20th century, this system worked well enough that most people did not think about it. You paid your premium. It went up a little every year. You accepted that as the cost of driving and moved on. The relationship between insurer and customer was transactional but honest. The company needed your premium to cover its claims. You needed their coverage to legally drive. Neither party loved the arrangement, but both needed it. And because car insurance is mandatory in 49 of 50 states, the companies collecting those premiums had a customer base that legally could not leave. That last detail matters more than it might seem. In almost every other market, a company that raises prices risks losing customers to a competitor. The threat of losing customers is what keeps prices honest. But when the product is legally required and every competitor is raising prices simultaneously, that mechanism breaks down. You cannot opt out. You cannot go without. You can shop around, and you should. But if every insurer in your state has raised rates by 20%, shopping around only gets you a slightly better version of the same problem. The insurance industry understood this. Regulators understood this, which is why car insurance became one of the most heavily regulated industries in America, with state-level oversight designed to prevent exactly the kind of price behavior that a captive market would otherwise invite. The system had checks, it had oversight, it had a logic that, on paper, protected the people paying into it. And then the pandemic arrived, and the companies discovered something. In March 2020, America stopped driving. Not entirely, but close enough that the insurance industry felt it immediately. Fewer cars on the road meant fewer accidents. Fewer accidents meant fewer claims. And fewer claims meant that the money flowing into the pool was no longer flowing back out at anywhere near the rate insurers had planned for. For the customer, this should have meant lower premiums. The risk had genuinely decreased. Some insurers issued modest rebates. State Farm returned around $2 billion to policyholders in 2020. Allstate returned $1 billion. The gestures were real, but they were also calculated, small enough to generate goodwill without meaningfully reducing the windfall that reduced claims had produced. Because what the insurers did not do was structurally lower premiums to reflect the new reality of the risk they were covering. They absorbed the profit from the quiet years, returned a fraction of it as a public relations exercise, and waited. They did not wait long. By 2021, driving had largely returned to pre-pandemic levels. And when it did, something had changed. Accident rates climbed. Repair costs had exploded. New vehicles had become rolling computers, and the sensors, cameras, and specialized components that now comprised a modern bumper cost multiples of what a bumper had cost 5 years earlier. Supply chain disruptions meant parts took longer to source. Labor shortages meant mechanics charged more. A fender bender that would have cost $800 to repair in 2018 was costing $2,200 in 2022. The insurers had a genuine problem. Claims were more expensive, and they had a story to tell about why. What they did not mention in the press releases, the regulatory filings, or the letters explaining your new premium was that they had spent 2 years accumulating reserves from the pandemic windfall, that the quiet years had been extraordinarily profitable. Instead, 2022 became the year the industry pointed to, the worst underwriting result in 50 years. For every dollar collected in premiums, $1.22 was paid out in claims. The numbers were accurate. The framing was not. And what came next was built entirely on that framing. The story the insurance industry told about why premiums had to rise was not false. It was incomplete. The costs were real. Modern vehicles had become genuinely expensive to repair in ways that nobody in the industry had fully anticipated. A 2015 car had a bumper. A 2022 car had a bumper containing radar sensors, parking cameras, and collision detection hardware that had to be recalibrated by specialist equipment after any significant impact. Climate was doing the same thing at scale. The National Centers for Environmental Information recorded 28 separate weather events with losses exceeding $1 billion in 2023, the most ever recorded in a single year. Hailstorms that had once been localized inconveniences were now totaling tens of thousands of vehicles across entire regions. Flooding that had once been a rare catastrophe was becoming a recurring line item. Insurers paying out on weather claims in states like Michigan, Texas, and Florida were absorbing losses that no company had modeled into premiums set 5 years earlier. Litigation was the third pressure. And it was the one the industry talked about least publicly, while lobbying against it most aggressively behind the scenes. Higher claim payouts meant higher premiums for everyone, including the drivers who had never filed a claim in their lives. Every one of these pressures was legitimate. Every one of them contributed to the cost increases that insurers passed on to customers between 2022 and 2024. But here is what the cost story left out. Costs explain why premiums needed to rise. They do not explain why the average full coverage policy increased by 55% between January 2022 and 2024, a rate that outpaced repair cost inflation, weather event losses, and litigation increases combined. This excludes the extra money pocketed during the quiet years. In 2023, the property casualty insurance industry posted $88 billion in profit, its most profitable year in history. The same year, it raised auto insurance rates by an average of 26%. The same year, it told regulators, customers, and anyone who would listen that rising costs had left it with no choice but to pass the burden on to drivers. Then 2024 arrived, and the number got larger. $169 billion in profit. A 333% increase from 2022, the year the industry had held up as evidence of a system in crisis. The year it had used to justify every rate increase that followed. The crisis year had been followed, within 24 months, by the two most profitable years the industry had ever recorded. Progressive posted a combined ratio of 86 in the first quarter of 2024, meaning it paid out 86 cents in claims for every dollar it collected in premiums. Geico posted 92. These were not the numbers of an industry absorbing catastrophic losses. They were the numbers of an industry extracting significant margin from a captive customer base that had no realistic option to refuse. Those executives collecting the profits did not go unnoticed. The 10 largest insurance companies paid their chief executives a combined $134 million in compensation in 2024. The industry's response to scrutiny followed a pattern that had become familiar. Spokespeople pointed to claims costs. Lobbyists filed paperwork with state regulators justifying the next round of increases. And the profits continued. What made this particularly difficult for customers to process was the gap between what they were being told and what the numbers showed. The narrative was scarcity, an industry stretched thin by forces beyond its control, passing on unavoidable costs to customers who had no choice but to absorb them. The reality was the most profitable period in the industry's recorded history, occurring simultaneously with the largest premium increases most drivers had ever experienced. Those two things were not supposed to be able to exist at the same time. In a market with real competition and real regulatory teeth, they probably couldn't. Number 5. The system that makes it impossible to fight back. In November 2023, the CEO of Allstate sent a message to regulators in California, New York, and New Jersey. It was not a request. It was a threat. Tom Wilson announced publicly that Allstate would stop writing new insurance policies in all 3 states unless regulators approved double-digit rate increases. Not ask, not negotiate. Threatened to withdraw from markets covering tens of millions of drivers, people legally required to have insurance, unless the price he wanted was approved. Within days, all 3 states approved the increases. This is how insurance regulation actually works in America. Car insurance is regulated at the state level, which sounds like consumer protection until you understand what it means in practice. It means 50 separate regulatory bodies, each with their own staffing levels, their own political pressures, and their own relationships with the industry they oversee. It means that an insurer unhappy with oversight in one state can credibly threaten to leave, because the alternative, millions of legally uninsurable drivers, is a problem no state regulator wants to be responsible for creating. The leverage runs almost entirely in one direction, and the industry spends significant money making sure it stays that way. In 2023, property and casualty insurers spent $57 million on lobbying, more than health insurance, more than life insurance, more than almost any other financial services sector. State Farm alone spent $5.3 million. Allstate spent $5 million. The target was not federal legislation. It was the state-level regulatory infrastructure that determined whether a rate increase request got approved or rejected. The results were visible in the approval rates. States that had pushed back hardest on insurer rate requests found themselves watching those insurers reduce coverage availability or exit markets entirely. California, which had some of the strongest consumer protections in the country, saw State Farm and Allstate stop writing new homeowners policies in 2023, a warning shot about what happened to states that did not cooperate. The market structure compounded everything. Car insurance looks competitive. There are hundreds of insurers. Comparison websites make shopping easy. The industry points to this constantly as evidence that market forces are working. What it does not mention is that when every major insurer raises rates simultaneously, responding to the same data, the same weather events, the same litigation trends, shopping around produces a better deal within a narrow band, not a fundamentally different outcome. You can save $200 by switching. You cannot escape a market-wide 26% increase by switching. The customers most damaged by this system were not the wealthy ones. For a household earning the median income, full coverage car insurance now consumed 3.6% of total annual earnings by 2025. In states like Louisiana, that figure was significantly higher. These were not discretionary expenses that could be trimmed from a budget. This was the cost of being legally allowed to drive to work. And the people setting those costs had just had the 2 most profitable years in their industry's recorded history. It isn't a scam in the legal sense. The premiums are disclosed. The policies are signed. The claims, when they're paid, are paid. Nothing about the transaction is technically fraudulent. The industry will tell you this correctly if you accuse it of wrongdoing. Since 2022, the average American has paid roughly $625 more per year for the same car insurance. The industry collected over $1 trillion in premiums in 2024 for the first time in its history. The CEOs overseeing that collection received a 27% raise. None of this required a conspiracy. It required something simpler: a captive customer base, a fragmented regulatory system, and the ability to raise prices faster than the costs that justified them. It's a system designed to ensure that the money flows in one direction. If you are curious about more corporate breakdowns, subscribe for more and click the link on the screen to keep watching.